What's up, guys? We're breaking down how S Corps work. If you watched last week's episode, we broke down how LLCs are actually an asset protection mechanism. They're not necessarily the gateway to tax savings like a lot of people think they are. However, an S Corp election might be. So if you're a business owner and you are not an S Corp and you're looking for a way to save on taxes, this episode's for you. Welcome back to another episode, guys. Again, my name is John Boyd. I'm a certified financial planner. I'm the founder and lead wealth advisor at Modern Wealth. We're a fiduciary fee-only financial planning firm located in Scottsdale, Arizona, but we serve clients all over the country. If you like today's content, be sure to like and subscribe and share with a friend. And of course, if you need specific one-on-one guidance, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth. We'd love to help you and your family out. So if you missed last week's episode, one of the key points that I touched on with LLCs is that LLCs in and of themselves have zero tax benefits, right? So let's say you are a business owner, right? Let's just say that you opened up a lemonade stand and you started selling lemonade and you made a ton of money. Well, from day one, when you start operating that business, you are a sole proprietor by default, right? If you set up an LLC, do you get any special tax benefits? The answer is no. A sole prop LLC and just a sole proprietor who didn't set up an LLC both are able to deduct expenses. They're both able to set up, solo 401ks and SEP IRAs for themselves. They both have to deal with self-employment taxes, right? They have to deal with all the normal stuff and take all the same deductions that any other business owner would take. And that is a mind-blowing concept for a lot of people because people generally believe that LLCs are needed for tax savings, especially in the context of a business. And again, because you've been watching our content, listening to our podcast, you know that that is simply not true. However, an S Corp tax election might. So what is an S Corp? Well, an S Corp, as I mentioned, is merely a tax election. So you aren't going to simply tear apart your LLC and establish an S Corp. If you are a sole prop LLC, you simply are going to request to be taxed as an S Corp, which we'll talk about in a little bit on how you actually do that. So you technically need to have an LLC set up to make the S Corp tax election, but you have to request it. And again, just having an LLC doesn't give you a bunch of tax benefits. But why the heck would anybody want to do this? Why would you want to have an S Corp tax election in the first place? Well, it all boils down to self-employment taxes. So let's go ahead and break this down with a couple examples. So if you guys are watching on YouTube or you're watching maybe on Spotify, utilizing the video feature, there's going to be a nice visual on your screen for you. But if you're just listening on the podcast and you're on a run somewhere, don't worry. I'm gonna do my best to break this down as simple as possible for you guys. So let's just start off with a sole prop LLC, right? You're not an S Corp. You're just a sole prop LLC handling business. Let's say that your business generates $100,000 in revenue. You have $30,000 in expenses and your net profit, your net income is $70,000, right? So on that net profit of $70,000, you are going to have to pay federal income tax. You're going to have to pay state income tax, and you are going to have to also pay self-employment taxes. If you're not familiar with what self-employment taxes are, if you have ever had just a standard W-2 job for a company and you take a look at your pay stub, you've probably seen a portion of your paycheck come out for Social Security and Medicare, right? That's called FICA tax. When you have FICA tax, the employer pays half of it and the employee pays half. So the employee portion comes out to 7.65%, and the employer portion comes out to 7.65%. So that's a chunk of your money just going out the door to Social Security and Medicare, or FICA. It's a pain in the butt, but we have to live with it. When you are self-employed, or a sole prop LLC in this example, you have to pay both the employer and the employee portion of that tax. So it ends up being 15.3% in FICA taxes. That's a lot. 15.3%. We haven't even touched federal or state income taxes yet. And you've already had 15.3% go out the door in extra FICA tax, or self-employment tax. So on $70,000 in net income, that would be $10,710 in self-employment tax or FICA tax alone. That's a lot. That's significant. So what do we do about that? What can we do to potentially save on taxes? Well, this is where the S Corp election comes into play. So let's look at the exact same scenario, but this time, let's assume that this sole prop LLC requests to make an S Corp tax election. So their sole prop LLC is now being taxed as an S Corp. Under this example, same exact scenario, their net income is $70,000. The difference, though, is that this time they're going to draw a reasonable salary. And remember that word, reasonable salary. We'll touch on it in a little bit, but they're going to go ahead and draw a reasonable salary. In this case, it's going to be $30,000 in a salary draw. The rest of it is going to be pass-through income or a profit sharing distribution. So the breakdown is $30,000 in salary and $40,000 in pass-through income or a profit sharing distribution. Now, why the heck would we divide up that $70,000 in net income that way? The reason why we would want to do that is that you only pay that self-employment tax, or that all that extra FICA tax, on the salary portion of your income. So you only have to pay that 15.3% in tax on that $30,000 salary. So this time, our self-employment tax is $4,590 as opposed to $10,710 when we weren't filing as an S Corp. So that's over $6,000 in tax savings alone in this simple example, right? Imagine if you were a company generating a couple $100,000 in net profit. You can really see the benefit of potentially making this S Corp tax election. So that's it in a nutshell, right? That's why you would want to make an S Corp tax election. But there's a couple of things that you need to keep in mind because it's not just that simple. So first and foremost, you have to request to make that election. You are going to request to file a form, a tax form. That form is 2553. This tax form, you are going to request that your LLC be taxed as an S Corp. You're going to make that tax election through that particular form. The deadline every year to make the election is March 15th. That's a super early deadline. So if you don't make the election prior to March 15th, you're potentially out of luck, right? Well, not necessarily. If you miss that deadline, you generally can make a late election and still make the S Corp tax election, even if it's, let's say, July, you missed it by 4 months. You'll need to work with your tax team to make sure that you make that election. Generally, it's not a huge deal, but you'll just need to request that it is a late election in order to qualify it for any particular year. Second big thing to keep in mind, remember how you have to take a salary. Well, when you take a salary, you need to treat it like a normal job. So the IRS requires you to have a formal payroll in place. So you need to hire a company to run payroll for you. That could be a company like ADP, Gusto, Paychecks. I mean, there's tons of different companies in this space that handle payroll. And it could range from anywhere from a couple $100 to much more than that, depending on your specific needs. But you'll need to factor that into the cost benefit analysis on if the S Corp makes sense for your business, because you are going to have to pay for a payroll service and you are going to have to run payroll. Now, how you run payroll, doing biweekly salary draws to yourself, whether it's a semi-annual draw, whether it's just a one-time salary draw, the last week of the year, right? That's going to be up to you to decide how you handle that. We'll do a separate episode on that if people feel like it would be beneficial. But bottom line is, you need to have a formal payroll system and provider in place. It's one of the rules that the IRS requires if you are going to be taxed as an S Corp. Other big consideration, remember how I said that you need to draw a reasonable salary. So you're probably hearing this strategy and thinking, well, if I have to pay self-employment tax on whatever my salary is, I'm just going to have my salary be like $5K. I'm just going to take this teeny itty bitty salary and the rest is going to be profit sharing distributions. Because remember, with the profit sharing distribution, you still pay federal and state income tax, but you don't pay the self-employment tax. So the name of the game is to thread that needle between not taking too big of a salary, but also not being heinously, conservative and undershooting it as well. So the IRS asks that you take a reasonable salary, and this is generally based off of your line of work, what type of work that you're doing, and your job responsibilities. There's tons of ways to calculate this number. Different tax professionals have different methods of doing this and finding this out. You could also do it yourself, but you'll need to determine what that reasonable salary should be, because in the event that you get audited, and an off chance that you get audited, you have to explain how you came up with your salary number. You'll just need to justify it and make sure that it's reasonable. So the other big consideration to keep in mind is that the salary that you decide to draw from the S Corp, that's ultimately going to determine how much you can put into your self-employed retirement plan. So me, I'm generally a huge fan of a solo 401k. So if you want to maximize your solo 401k benefit, remember, the employee max is $23,000, and then you can go ahead and do a match of 25% on the employer side. And remember, you get to play both sides, the employee and employer side. The problem is that if, let's say, your salary is only $30,000, you don't get to do the math, right? The 25% match on your net profit. It's only on that salary. So if you really want to put a ton into your, let's say, solo 401k, you're going to have to inevitably increase what your salary is. So it's a balancing act, right? You maybe don't want to pay a bunch in self-employment tax, but at the same time, you still want to maximize how much money you put into that solo 401k plan in this example. So that salary, whatever that number is, you have to thread that needle between, yes, I want it to be reasonable, and also at the same time, it needs to strike a balance between what is an optimal amount that will allow me to avoid self-employment tax, and at the same time, still maximize my contributions into my plan. So keep that in mind, because again, the math is based on the salary, not the net profit. So there you have it, guys. That is why a sole prop LLC, right? It's not your ticket to tax savings. In theory, yes, you need to have an LLC to make an S Corp election, but most people, they don't realize that. right? If you want to actually save on tax, you have to explore making these type of moves like an S Corp election. Now, an S Corp election is not always going to make sense for everyone, depending on what your net profit is for the business. If you're just getting off the ground, or heck, you don't have any profit yet, it probably doesn't make a whole lot of sense to set up an S Corp. But as your business starts growing, maybe your net profits now are, $60,000, $70,000 and up. Now we're in that area where, heck, we need to start thinking about being a little bit creative with these type of moves. If you need one-on-one help with your own self-employed finances, right? Being a business owner is tough. We work with a ton of business owners. We do a ton of financial planning for them. Reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. It's been a ton of fun, guys, and I will see you next time.